So anyway, whatever your desires and needs are out of the business, you cannot overstress the business because you're stressing the cow. One of the comments I'm known for in the book is, you can keep your cow healthy and milk it every day, or you can starve it and we can have one barbecue dinner. What do you want to do? And this guy is headed to the barbecue. And it's not really going to feed everybody either after the barbecue. So what do you want to do? Now, how many of you have more than one shareholder in your business? So not a lot of folks. So I'll touch this just briefly. Just because you're an owner in the business does not mean that you should both make the same amount of money. Matter of fact, I put this kind of blatantly in the book. Fair does not mean equal. My kids have heard that. I've got 4 kids, and I told them all. I says, I love you dearly, but I'm going to treat you all fairly, but I'm not going to treat you equally because you're 4 distinctly different people. And they understand that because I'll do different things for different ones because they all have different needs. No different between owners. And if you go back to my original statement, you get paid a salary for what you do, return on what you own. I've never seen 2 people worth exactly the same amount of money for the job that they do. Because one, you're both not doing the same job if there's 2 owners in the business. Somebody's probably involved in sales and marketing, somebody's involved in operations, or a little overall blend of both, but one's primarily driving one, one's primarily driving the other one. Just go pull some wage surveys and see what the market thinks about the values of those jobs. And that's really what people should make. So this is an example. So, in the previous slide where I showed you that example of the guy making 25% profit, that was actually a real experience of a client of ours that had 2 50-50 shareholders. And when they were making, probably $700,000 in revenue a year, they attended one of my talks and they said, oh yeah, we're at 25% profit. And they started telling me about their cash flow problems though. So I got a hold of their books and I reclassified the distributions that they were taking that should have been salary as wages, and they had 3% profit instead of 25. And I'll show you their example of data. I've got their data set here a little bit later that I'll show you an example of what happened after we reset it. But in their case, we actually went through a similar example of this to where after I'd worked with them a couple of years, I said, all right, guys, I just have to tell you, I put this in the book, so I got to defend it. You guys should not be making the same wage because you're each not doing the same job. So we developed this grid to where we looked at each role, we looked at the market wage, the high, low, and the midpoint, and before I showed them the wage amounts, I had them tell me the percentage of time that they spent in each one of these functions. Now I want you to notice something here, because how many of you are spending time in your day doing this job, these 2 right here? Now those are important functions, but are they the most valuable functions for your time? If you want to make this wage, are you doing low-value tasks instead of these tasks? So, it's physics, folks. You can't overpay yourself. And so the idea is we had them put the percentage of time that they spent, and notice what happened was the CEO and the salesperson was going to make 155 and the other person was going to make 146. And so when I shared that data with them, they both looked at it and go, okay. It was objective. It wasn't that one person wanted, the CEO was not lobbying for more pay, because there may be a point that the CEO decides to spend less time in sales and they go hire another salesperson instead. Well, should their pay go down because they're not working, they may not work full time? Because think about life, folks. You are not going to hit it the same level of intensity and effort throughout your whole career. And your wage has to be reflective of your performance and the amount of time and attention you spend in your business. And it's perfectly okay to spend part-time in your business. Because a small business, like I said, it doesn't need a full-time CEO, or else you're being overpaid. I talked to a venture capitalist the other day, we were on a trip together, And he said, you know, when these startup businesses, these guys want to make a big CEO salary. He says, great, I'll pay you a big CEO salary if you're also in charge of sales and marketing and operations. But I'm not going to pay you that salary to just be a CEO, and then you got to go hire 3 other people for those other roles that they're not even fully developed yet because of the stage of the business. So does that idea make sense to everybody? So I'll give you a good example on this idea of working to value. So we have this dentist client that there's 2 dentists that own 3 locations, and other dentists work for them. And so we were in a partner meeting, and one of the dentists was complaining because he only made $300,000 that year instead of his partner who made $750,000. And he says, I'm spending more of my time managing the business. And I go, you're absolutely right. We need to fix that. So what we're going to do is we're going to calculate all of the hours that you spend managing the business, and we're going to pay you at a rate of $75,000 a year for that time that you spend managing the business, because that's what the rate we would pay someone as a practice manager for a 3-location dental practice. And to prove it, we actually ultimately hired the person for them and put them on site, and that person was paid $75,000 a year. So we're on target with a number. And so I was explaining to him, I says, now, you can do that if you want to do it, but if your stated goal is to make more money, let me remind you that if you have your hands in somebody's mouth, you can make a low of $300 to a high of $750. So it's your choice. As the owner of the business, you get to pick any job you want to do. That's your prerogative. But the market picks your pay. Because if you want to overpay yourself for that job, you're stealing it from the bottom line of the business. You're distorting your data. So, you know, that's one of those things that, you know, you think you can get away with it. It's physics, folks. You can't get away with it because the market is a very cruel taskmaster. It will only pay you so much for the value of that job that's being done. So this is a little chart that I put in there because the other thing that you guys have a tendency to do is to pay everybody else and not pay yourself. You know, probably I won't ask for a show of hands, but there's probably a few of you who are not making a market-based wage. And, you know, that sounds, you know, very what's the word? You know, it's very noble of you, you know, to do that. But you got to stop that, because if you don't exist, they don't exist. And now there's a time to have sweat equity, but you've got to secure your stability in the business. And that's why if you pay yourself a market-based wage, I believe emotionally you will defend that number more so than you'll ever defend profits. But then I ultimately want to teach you to defend the profits of the business as well. Okay? So basically the benefits are, I mean, so if you get this right, net income's now the right number. You're going to live off your compensation net of taxes as if that's the only money that you're making. So you've got a fence around that thing that I've got stability in my home life and I'm not using the business as my piggy bank. It's going to prevent resentment. You're going to resent it when you have to write a paycheck for everybody else in the business and you go without. I mean, it eventually gets kind of old, I can tell you. You're going to avoid IRS problems with payroll tax avoidance. But more importantly, it establishes this framework that we'll talk about a little bit later about paying for value. I don't mind, I'm happy to pay anybody in our business market value if I get market-based performance. And it's a great level of exchange because I'm no longer feeling like somebody just wants to grab something from me. It's a fair exchange. Give me performance and I'll give you compensation. I'm happy because I know that the business can succeed in that way. All right, so let's talk about data then. So now that we've cleared up the distortion, I'm going to create some new definitions for you and a couple to ignore. So the first one is EBITDA. If you haven't heard the term, earnings before interest, taxes, and depreciation. The only thing I'll say here is really the key here is about depreciation. You know, the finance types want to add back depreciation. We didn't go around, so I don't have an idea of what kind of industries you guys are in, but you know, we had some guys last night that we were talking to that are bigger businesses that have heavy equipment and that wear out. You know, one guy was in the HVAC business, and I said, hey, does that truck last forever that you drive around to fix everybody's HVAC? Absolutely. Well, why would I add depreciation back on that truck? Because I got to eventually replace it. It's a real cost. And the problem is our profession screws it up too, because I'm giving you tax depreciation to put back into your books, not what depreciation concept was originally designed to do, which is to spend $50,000 for a production vehicle that lasts over probably a 3-year period. It probably won't even, if I'm driving at 100,000 miles a year, you know, I'm probably not even going to get 3 years. I'm probably going to use it over a 2-year period. Depreciation is intended to be an economic replacement estimate of what I spent and when I got to replace it. So one of the things you've got to work with is work with your accountant to say, quit putting that tax stuff back into my books. I want to know real economics. You know, what is this depreciation that's being taken out over time? Because you will eventually have to replace that piece of equipment. The best number to focus on is pre-tax profits. So we believe that's an easier number to focus on. And I explain it like this. If I go out and buy a $100,000 corporate bond that pays me 5% interest, well, I know that I get $5,000 for giving it $100,000. Well, you want to do the same thing. How much money have I put in the business? What's my equity in the business? And what has it returned me? See, that's the magic of building wealth. And I'll give you a little clue. If you have a healthy business the way we define it, and I'll define that a little bit later, we believe every business has the capacity of producing about a 10% profit off of that equity. When a business is producing 10% profit and it's fully capitalized, it is a minimum of 50% return, year after year after year. So if you, give you a good example. So I got a nephew that our family kind of did a little family capital raise and helped put him in business. So he didn't have to borrow any money. He's doing about $700,000 a year in revenue, and it took $150,000 to get him into business. And that business should produce $70,000 at 10% profit on $700,000 in revenue, should produce $70,000 a year at 10% profit. Actually, it should do about 75. So let's say if it's 75, that makes the math real simple. So 75,000 net profit on 150 investment. That's 50%, folks. Now that's over and above his wage that he's getting to run that business in that process. It works. It works for every size business out there, regardless of if you're under $1 million, over $1 million, or over $100 million. Same difference. That's how wealth is built. And it's more built, I believe, the business media loves to convince you about building a business to sell. I got news for you. I want you building wealth while you own the business, because that's actually the safest way to do it. If I build a business that's profitable and I'm harvesting the wealth on top of me making a market-based wage for the job that I'm doing in the business, I'm building wealth as I'm going. I got the best of both worlds. I'm milking the cow, and I still own the cow. Once you sell it, you've had the big barbecue, folks. I hope you saved enough to last. And that's the fallacy, because there's too much press, I believe, around the selling of a business rather than the running of a long-term business. So I shared an example last night, a client of ours that's been in business for 20 plus years. And 20 years ago, they were doing $2.5 million in revenue, making about an $800,000 net profit after market-based wages. And 20 years later, they're doing $4 million in revenue, making $1.4 million profit after market-based wages. Over that 20-year period, they have developed $12 million of after-tax wealth for the owners of the business. After their wage. Because they live off of their wages. They don't spend a dime more to live than what they make, because they make good wages. They don't need to spend any more than that. They have built $12 million of wealth. And oh, by the way, they still own the cow. And Why can't you do that? We can. You just got to get focused on what works and why it works and how to do it in that process. So the key here is the weak one that I'm going to tell you to not focus on is revenue. And you may think that's odd, but revenue is not real. Revenue is a vanity number. So good example, we got a client who's in the distribution business, and they have $60 million a year in revenue. But they make 15 points of margin off of that revenue. What they really are is about a $9 million inventory services business, because all that cost of goods sold turns over, and that's just really pass through in reality. And I'll show you an example of this on the next slide. But essentially, you've got to think in terms of what is your true revenue. And we believe this next line, gross margin, this is the true revenue of the business. And so if you really focus on gross margin, I want you to just quit talking about revenue. I want you to find a way to talk to your employees about gross margin. Gross margin. It's not about revenue. Because if I have a $100,000 job in revenue, but I've got to give up $80,000 of it in cost of goods sold, it's only a $20,000 job versus if I get a $50,000 services contract that I don't have to share it with anybody else, which one's better? Mentally, if you keep talking about revenue, people will going to incorrectly assume the $100,000 is better. No, it's not. It's the $50,000. Even better than that, so we define gross margin, let me go through this definition, is revenue minus direct cost that excludes labor. We do not ever, ever, ever want to mix labor with anything that's not labor. I mean, just stop that if you're doing it, because labor and other costs do not mix. They're distinctly different. And then the final piece is gross margin minus direct labor is what we call contribution margin. We believe this is the output of your economic engine. So this is the breakdown, and I'll show you this example. So we split the P&L in two, and we call this the business engine, we call this the chassis of the business. And so the reason why we describe it that way is, do you have a big chassis with a little lawnmower engine, or do you have a big Cobra engine with a Volkswagen chassis? Well, the two have to fit together. And so you've got to make sure, do I have the right chassis for the right engine? In the engine part, there's only 3 data points. You got revenue, these direct costs, cost of goods sold, and then direct labor. So in the construction company, it's the most extreme example I can use. So you got a construction guy, and he's, I own a $20 million construction business. He's got a pickup truck. Well, he can do that because $5 million of that is materials. Did he make the materials that he put on the job? No. He didn't even pay for them. He took a draw against the job to pay for the materials. Was that revenue? I don't think so. Realistically, if I was going to account for it, it's just a wash. It's a pass-through because he didn't have to front the cost. Same with subcontractors. He doesn't pay his subs until he gets paid. He doesn't have any cash flow risk. He has performance risk. He's got to make sure they got to do the job. But at the end of the day, I mean, and even if they don't do the job, he's going to hold them accountable and beat them up until they do it. You know, get it right for the most part. So in reality, this $20 million construction guy, I contend, is a $2,850,000 services business doing construction services. Because from here, he's exactly the same as a $3.7 million services business that had $900,000 in subcontractors. And from here to here, they look, well, I've made the numbers look exactly the same, but I can tell you from reality of data, they will look exactly the same. So regardless of industry, all of you guys are in all different businesses. If I take your data and force it into this format, you all could sit around, regardless of industry, and have a very robust discussion about your business because I've created a common language for everybody to see it in. And you will find that there will be some significant commonalities. between the gross margin and the relation of gross margin to direct labor. So this direct LER is a term that we'll talk about a little bit later called labor efficiency ratio. But to introduce it at this point, it's essentially this $2.85 is for every dollar of direct labor that I spend, I'm getting $2.85 of gross margin. So we look at labor as a multiplier, not as a percentage. Who wants to be a fraction of something? I mean, that's not very motivating. You know, but I'm a multiplier. If I put a dollar of good labor towards something, how many dollars do I get back? Now in the book, I only talk about this overall number here, this $1.63. And at the time that I was writing the first book, we were just developing this split concept of evaluating direct labor versus management labor. And it was a project that we were doing with a landscaping company in Omaha, Nebraska. And so we broke their labor down by division. And so we had the landscaping division, the irrigation division, and the mowing division, which they call the turf division, but it's a fancy term for mowing. You know, so they had a 4 labor efficiency ratio for irrigation, and they had a 4 labor efficiency ratio for landscaping. They were only getting $2.50 labor efficiency ratio for mowing. And so they shared that information with their team, and the guys that were doing the mowing, who make $10 an hour, said, "Do you think we ought to be in the mowing business?" I mean, here's a $10 an hour person who has enough brain cells to look at this going, well, if you're making 4 on these other things, you're only making $2.50 here, why are we doing this? Because you can only drive a mower so fast. I mean, you can soup them up a little bit, and so it caused them to readdress their mowing division. Now, what they did is they got rid of all of the price-sensitive mowing-only contracts, and they kept the mowing contracts that were part of landscaping and irrigation services. You know what their labor efficiency ratio is today on mowing? Not quite to 4, but it's 3.8. Significantly improved their profitability on that, just because they understood this. So it's that idea of the multiplier effect. Now, once you get past contribution margin and we get into the chassis of the business, we think these are the only 5 buckets that matter. And everybody wants to have different ones, and I go, sorry, for me looking at your data, these are the only 5 I'm going to look at. Facilities, which means rent, utilities, repairs and maintenance, IT, telecommunications. Now, that number doesn't change much. So it's pretty simple. Marketing, here's my plug for marketing. The most underspent line item on the P&L that we see, 9 out of 10 businesses are not spending enough on marketing. So when you guys have speakers in to talk about marketing, you need to pay attention and you need to come up with a marketing strategy and then go execute on it. And some of you you may struggle to have the resources to do it, but you got to be doing it. You got to market. Because Vern Harnish, who did the forward for my book, as well as I contributed a chapter to his most recent book, he and I both agree that the most dysfunctional function of your business is marketing. If everybody could just do a better job of marketing, you would really improve your business performance significantly. But it's a little bit of a black art too. So I challenge my marketing clients. I have quite a few marketing firms as clients. I challenge them. You got to find a better way to work with the entrepreneurial community too. So both groups have to work on it in that process. But I can tell you it's an absolutely needed thing. Management labor, by default, anybody who's not in direct labor is in management labor. So you go in one bucket or the other. And you know, you've got some people that are blended. I'm actually considered direct labor in my firm because I still spend, you know, the vast majority of my time is still in productive, billable things, you know, so I go there. So the key is you want to be consistent. We do not recommend fractionalizing, putting a half of a person in one place or a half in the other or a third or whatever. A body goes in a bucket one way or the other. So traditionally in professional practices, if you bill time, you're going to go indirect. So in our office of 25 people, there's 4 people that go in our admin bucket, our firm administrator and our other 3 admin support people. But everybody else is indirect in that part. Payroll taxes and benefits. Accountants love to allocate cost. I do not like to allocate cost unless I absolutely have to. And I want to manage payroll taxes and benefits as a bucket in and of itself. Because can your employees do anything about payroll taxes? No. I mean, the only variable number that you have in there is, do you contribute to a retirement plan, and what are you paying for health insurance? Those are the only discretionary things that you have in that bucket. And once you set those, they tend to not change much. You can't just change them on a whim, you know, in that regard. The other thing I will say this too is, so these are labor dollars. Now, you guys probably think in terms of FTEs, full-time equivalent employees. Just stop it. I mean, that's just a stupid calculation because it makes no difference. It's not about bodies. It is about the productivity of a dollar of labor deployed. Because not every dollar is the same. And, you know, it doesn't matter. When I was the controller for a bank before I started my firm, I had 20 employees in the bookkeeping department. And the bank was always looking for a way to cut staff. And I said, well, I can get rid of 10 of them if you'll let me pay the other 10 I want to keep a little bit more. I don't even have to pay them as much as the 10 I got rid of. I just need to recognize who's better and who's not. And they said, oh, we can't do that. They didn't like having me on the payroll committee because I had these crazy ideas even back then. So the idea is about what that productivity that you get out of it. And there are times that, you know, I can take a $20,000 of labor and make a 4 multiple on it versus, you know, if I get $100,000 of labor, I only get a 2. Well, you know, if I'm counting both of those as an FTE, that doesn't make sense. I mean, it's an irrelevant calculation at the end of the day. So what we want you to understand is when I spend $1, now remember, how do I spend that $1? Well, some people are paid a salary, some people are paid hourly, some people are paid on commission, some people get bonuses. $1 of labor is $1 of labor, folks. So, you know, you keep passing it out and giving more money. If you don't expect more return out of it, you're just digging a bigger hole for your business to fall into. So the key is if you expect return for every dollar invested in that labor, you're going to have a profitable business. And it's just the way it works. All right. By default, this last bucket, other operating expenses, if it's not facilities, if it's not marketing, if it's not salaries, if it's not payroll taxes and benefits, it is other operating expense. It's the biggest bucket of accounts, but many times it's one of the smaller dollars because it's all the noise. And you can't cut kitchen supplies enough to get profitable. So quit aggravating your team. I mean, you're paying attention to stuff that just doesn't matter. If you get this part right up here, I want 90% of your waking time and attention on revenue, direct cost, and direct labor. You get that part of it right, your business will do well. The rest of it, like I said, the only thing that I've seen down here that is a crazy spend is consultants. Now, I make my living doing this, so I'm preaching to the choir here. But the next time I walk in and see somebody having spent $100,000 with this name brand consultant, and I go, well, what did you get for that? I mean, I spend the money, but hold them accountable to give you something back in return. And if they don't, get your money back. Don't even start the process until they guarantee results, or else they're going to give you their money back. Because it's just stupid. And you would be surprised at $1 million businesses that have spent $100,000 on a consultant. It's like, I'm all for buying knowledge. I mean, you know, but just hold people accountable to give you value for what you spend. And I'm okay with that. But time and time again, it's like you keep looking for somebody who's got the magic profit beans, and they don't exist. It's called hard work, good strategy, and execution.
Correct.
Yes?
I'm math challenged.
Okay.
So my labor efficiency ratio, I was dividing my direct labor into my gross margin.
Correct.
How do I get my management?
So management labor is held accountable to contribution margin.
Okay.
So, and that's a good point. I should have had that on the slide. So the reason why we hold management labor accountable to contribution margin is that management is responsible for three things: driving revenue, managing direct costs, managing direct labor. You've got three crystal balls that you're keeping up in the air. You let one of them fall, you've got a problem. Whereas direct labor, they just have to be efficient at executing on the work that is put in front of them as gross margin. So that's the difference.